Today, we're going to be taking a look at a really hot stock in the market right now. We're going to be taking a look at a stock that I think is very undervalued and has a lot of potential to grow your money. And it's a very volatile, very interesting stock in the market right now. You probably haven't heard of it. If you want to see more content like this, make sure to drop a like, subscribe, and let's get right into analyzing this really interesting stock. So the stock I'm talking about today is none other than the Cheesecake Factory. The Cheesecake Factory is a restaurant chain in America. The Cheesecake Factory is a $1 billion business, a $1.1 billion business. So in the grand scheme of things, the Cheesecake Factory is a very small business. They don't have a lot of market share when you compare them to some of the big players like McDonald's and Burger King and Yum Brands. And they have about 200 stores in America. So they're a really small restaurant chain. And if you take a look at their menu and the foods that they offer fairly expensive items. These are things you're not going to be eating on a daily basis. You're only going to be eating these items occasionally. If there's a special occasion like a graduation, a birthday, or you just want to go out and eat with friends and family, that's the kind of restaurant this restaurant is. It's a restaurant that you pay for the experience as well. You pay to go and eat at this restaurant. You pay for the experience of eating at a nicer place. And the Cheesecake Factory is down huge due to the coronavirus pandemic. Obviously, they're down. They had to close down a lot of their stores due to the coronavirus pandemic. So their stock price took a very big hit, and it went as low as $15 per share. But more recently, has made a really quick and large comeback. It went from a low of $15 per share all the way to trading at about $30 per share at one point. So essentially, if you bought at the low and sold at the high, you could have essentially doubled your money. I know it's pretty hard to buy at the exact low and sell at the very tip high point. But if you did, you would have really doubled your money. So it just shows that this stock has really made a very quick recovery. And the main reason it's made a really quick recovery is due to the Cheesecake Factory offering limited dining at 65% of its restaurants by mid-June. So essentially, by the time you're watching this video, the Cheesecake Factory is offering limited dining at a lot of their restaurants. What this means is that they're going to be able to continue to generate revenue or actually restart generating revenue. And obviously, if the company is going to start making more money, a lot of investors are going to get interested in the stock. But that's not the key piece of news that's really big today. The really big piece of news with this company is not about that they opened their stores, it's about how their stores are actually performing. It doesn't matter if you reopen your stores during a pandemic if no one's willing to go out and eat at your restaurant because they have fear about getting the coronavirus. They need to recapture a large base of their customers in order to become profitable. And according to the Cheesecake Factory's management, they reported that sales figures have bounced back to about 75% of last year's figures. So out of all the stores that have reopened so far, their sales figures are about 75% of what they were last year. So their sales have almost entirely recovered. They're seeing almost the same amount of sales as they were seeing last year, based only on the stores that have reopened so far. So this Cheesecake Factory is actually doing quite well, as they're seeing a lot of their customers come back. You might be wondering, why are the customers coming back to the Cheesecake Factory? I thought everyone was eating at home and making their own meals. Well, you have to keep in mind that the Cheesecake Factory is a restaurant where people normally eat out on occasion. You don't eat out here every day. So a lot of people do want to celebrate things like graduation, birthdays, and just to go out on occasion and eat out. So a lot of people are okay just in the middle of a pandemic going out to eat out on occasion. There's very little risk of going out once in a while. So a lot of people are okay eating out at the Cheesecake Factory. And this has led to their sales being really similar to what they were last year. So this is very good for the Cheesecake Factory. And also, the Cheesecake Factory has a really strong advantage over a lot of their competitors in the market. If you take a look at the interior of their restaurants, you can see that they're pretty ginormous. The Cheesecake Factory has a huge interior. And what this has allowed the company to do is to maintain social distancing guidelines. But they are still able to have enough customers within their store in order to generate a meaningful amount of sales. This means that if there are any long-term impacts with the coronavirus and if we still need to maintain social distancing guidelines, the Cheesecake Factory will be able to generate sufficient amounts of revenue still. So that's a really good sign for their long-term potential. And if you compare that to other restaurants where people are sitting in closer proximity, they can't hold as many customers, and that means those restaurants potentially won't make it because they won't be able to house enough customers to break even. So the Cheesecake Factory definitely does have a huge advantage just by pure luck, and this is going to help them weather through this crisis. And also, it's really nice that the Cheesecake Factory does not have a lot of debt at all. Last year they had $10 million in long-term debt, and this year they have $290 million. $290 million is not a lot of debt for this company. They have over $2 billion in assets. So this company is not too heavily financed by debt. And you might be wondering, why do they have so much debt all of a sudden? Why did it go up from $10 million to $290 million? Well, they recently acquired some other restaurant chains, and they financed the acquisition through debt. So it's kind of unfortunate they acquired a restaurant right before the coronavirus pandemic hit. So the restaurants are not going to be generating as much revenue as they thought. But as long as the businesses that they acquired are able to be profitable, then it's a really good acquisition because they're going to be able to, one, cover their debt, and they're going to be able to increase the amount of cash they're generating during these times, which is going to help them weather the crisis. So although it's kind of unfortunate they bought a restaurant right before the coronavirus hit, it's not too bad because it's going to help them increase the amount of cash they're generating, which is also going to help them weather through this crisis. So overall, it was not a bad acquisition at all. And when you take a look at their dividend, the stock looks so much more attractive until you realize that Seeking Alpha did not update their data yet, and this stock actually suspended their dividend. Yeah, that's right. The Cheesecake Factory did suspend their dividend, so they're no longer a dividend-paying company. Although they did suspend their dividend, that's never really a good sign. I do think it was a smart move by the company. If I was the company owner, I would definitely suspend the dividend because I would want to keep as much cash in the business as possible because times are so uncertain. And one day after the coronavirus is gone, or at least when the situation is a lot better, the company will probably continue and restart paying their dividend, which is going to make it a good long-term dividend stock as well. And when you take a look at their forward PE ratio, it's at 11. 11 is such a low PE ratio for this company. And it just shows that the stock is very undervalued in general right now. And here's my overall verdict and judgment on the stock. Obviously, they're going to face some challenges coming up. Their revenue is not going to be at their 2019 levels, so they have to deal with that. And also, they have to deal with that they paid $290 million for a company that's now not going to generate as much revenue as they thought it was going to initially generate. So they're definitely facing some challenges. But the stock is down 40%. And if theoretically the situation never recovered and it just stayed like this, if we just had a coronavirus pandemic for the rest of eternity essentially, I do think this stock is still undervalued because this stock is still able to produce a lot of cash and it'll make a lot of money even with these current situations. So as long as the situation does not get worse for this stock, I definitely do think that it is undervalued. But let me know what you think of this stock down in the comments below. Drop a like and subscribe. It really helps out a lot. But other than that, I hope to catch you in the next video.